Hey, good morning again to all of our options traders. And it's that time again for more idiotic ideas. We're up to number 9. Get the biggest bang for your buck. Well, for anybody who might be new to this series, the backstory is I got these from a book. I'm not going to name the author or the title, but instead it's just to show why you have to be so careful where you get your information from. This guy claims to be a professional trader and have run a newsletter and all of these things that says he supposedly knows what he's doing. But when you go through the book, it is an absolute gift for coming up with ideas for videos because they're just packed full of really bad ideas. And so I found it just odd that somebody could put a book together of so many bad ideas. And I thought, well, let's use it as a learning tool. So that's the story on it. And let's go take a look at Idiotic Ideas number 9. Get the biggest bang for your buck. What's this all about? Well, before we get started, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So here is a direct quote from the book. And he says, when you pay a high price for an option, you have a lot of risk. One wrong move of the underlying stock and most of your option premium could vanish. If you pay little for an option, if the stock moves the wrong way, you won't lose much. Also, the higher the price, the lower the chance for a big percentage gain. Well, right off the bat, this is just packed full of bad ideas. Let's start up here with high price. Remember, options are measured in volatility. He's measuring in dollars. So he's saying if you pay too high of a price tag in terms of dollars, you have a lot of risk. Well, again, remember, risk is not measured by dollars. It's measured by the percentage chance for a loss. That's exactly why you pay a lot for a treasury bill. You might pay $950 to have it mature to 1,000. It's a very low return. Why? Because it's very high probability. In fact, it's guaranteed to return the maximum. But here he's saying that a high price means a lot of risk, which is absolutely the wrong definition of risk. In fact, it's just the opposite. Things that are super low priced are that way because they are high risk. Things with very high prices are priced that way because they have relatively low risk. We've seen that in the risk reward video. But if you want to follow his definition of risk, that you should be paying low dollars, well, then, according to his definition, you should be playing the lottery because that's the lowest risk of all. You can only lose $1 and you might make a huge percentage gain. You see, when you view it in that light, you realize that this is simply a high risk strategy. So we're not even into the first sentence and we have a really bad idea. But over here is just a restatement of it. If you pay little for an option, again in terms of dollars, then you won't lose much. So again, well, if that's true, then buy the options as far out of the money as you can. Hey, you won't lose much. Play the lottery. Hey, you're only losing $1. But keep playing it and you'll find that's not the way to generate gains. Same is true for the stock market. And then finally, to top things off, also the higher the price, the lower the chance for the big percentage gain. We've talked about this over and over. Percentages are not money. Don't be fooled by this. Yeah, you might pay $1 for an option and sell it for 3. Congratulations, you made 3 times your money, 200%. It's 200 bucks. It's probably not going to be life-changing. We're here in this type of a game, in the investment game, to make lots of money, not percentages. So yet he's already showing people this big fallacy that you want to make big percentage gains and probably not a lot of money. All right, so you can see that just immediately this is just filled with really bad ideas. So his proposed guideline in the book goes like this. Avoid paying more than $2 for any stock option. And he gives different prices for futures or index options, but for any equity option, he says $2. Well, again, that's measuring it in dollars. And again, his reason for suggesting this arbitrary price is that it provides a chance for a big percentage gain or a home run. And that's what he's calling the biggest bang for the buck. Well, usually when people say the biggest bang for the buck, they mean the best value. What he's suggesting here is, in other words, only take high risk. And what that translates to is that you have a greater chance for losses. Well, that's not really a good way to make money in the options market. So where does he get this $2 value from? Who knows? It's just some number that he's plucked out of the air. But you also see this among a lot of traders that they want to keep these dollars low because people are very risk averse and they'd rather have a low chance for success if it means they're guaranteed to limit their losses. So you can see that this guy probably isn't a really good trader. He's scared to death of putting money at risk, but to do it in a sense that he has a high probability of accomplishing his goal. He just wants to put a little bit of money on the table and hopes that he can make a big home run so he can brag about it in the newsletter. So, as we've talked about before, but as a refresher, remember that options are all about volatility. Options are priced in volatility, not dollars. Anytime you see somebody that says don't pay more than $2 for an option is dead wrong. That's measuring it in dollars. Because according to his guideline, a $2 call might be outrageously high priced. If, let's say, the theoretical value is 30 cents. On the other hand, a $20 call might be unbelievably cheap. Try to buy a 1-year option on Nvidia at the money for 20 bucks. Not going to happen. But if you could, you would say, man, that is a steal. Well, hold on a second. It's a $20 option. It's 10 times more than what he's suggesting. Why would you say it's a steal? Because you'll recognize that has a lot of potential to make a lot of money because there's tremendous volatility. But if you follow his guideline, remember that $2 options will be associated with either low volatility stocks, in other words, very low chance to move at all, or they're going to be shorter term. They might have some volatility, but then you're not going to be able to get them for $2. So you're going to be playing things that expire in 3 or 4 days, which means you have a low chance for it to move very far. Or you're going to have to play them far out of the money, which means they have a low chance to even go in the money. So again, you've just got a low probability for gains and a high probability for losses. Okay, so as I've mentioned in previous videos, I don't usually like to talk about the negatives. Again, this is just such a layup, you just can't help it. But let's take a look at what should you do. Well, the things that I always try to point out in the videos, you've got to have some type of a goal. And if you have a goal, the answers become easy because you can say, well, I'm trying to make, pick a number, 20% of my portfolio per year. Well, okay, now we've got something we can measure and work with. I don't want to invest in something that has a potential return of 30 or 40 or 50%. That's taking more risk than what I need. So in that case, I might move my option more in the money or my vertical spread more in the money, which means I have to pay more for it. It's got a higher probability for success. But what he's saying is no, only take these $2 options. No matter what the expiration or the stock or what your goals are, just play $2 options. But you can see over here in the E-Trade platform, here's the SPY. Markets are not open yet, but it closed at about 504. But if you play the at the monies, the 504 strike, there's 11 bucks. And that's only 31 days to go. So where do we find a $2 option? Right about there. It's actually 214, but we'll cut them some slack. And that's the 526 strike. But that's a little over 4% out of the money. How often does the index move 4% in a month? And that's just to get you at the money. See, this has got a very low chance of paying off. Now, if it does, let's say if it goes a couple of points in the money, yeah, you've doubled your money, but it's only 200 bucks. Even though the index made an outrageously high percentage move, you didn't really capitalize on it. It's nothing to brag about with percentages. Let's go take a look at Nvidia. Now, Nvidia's got some volatility to it. So we'll keep the expiration date the same. The stock was 860 on the close. So if you come down to the at the monies for 31 days, that's a $47 option. And what he's saying is that there's no way you should be paying that much for an option. So what he's suggesting is to come down here. Here's one for $2. That's the 1110 strike, which is about 30% out of the money. Now, yeah, Nvidia can be a mover, but still 30% in a month is a big move. And that's just to get you at the money. So again, this idea of just picking an arbitrary line in the sand at $2 and saying that everything below is good and everything above is bad has got to get one of the biggest awards for being a really dumb idea. Instead, focus on your goals, your hedges, rolls, and morphs, and you'll have much better success for meeting your goals. And that's what's more important, not the percentage gains. And so, for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.